Coco Alcuaz talked to Mark Canizares of Manulife Philippines about the prospects for Philippine stocks, sectors that are driving growth, the recent debt rating upgrades, and what the so-called U.S. fiscal cliff means to the country. Here's that interview.
Philippine stocks are among the best performers in the world again this year, and as the country's economic growth outpaces its neighbors and the country heads to an investment-grade debt rating. With us to discuss whether and at what pace this continues, Mark Canizares, Head of Equities at Manulife Philippines. Mark, thanks for joining us.
Good afternoon, Coco.
Let's talk about prospects for the Philippines. Great performance relatively this year. Is this going to continue?
Well, our expectation is still that we're at the very early stages. The market, as you said, has been one of the best performers, and in fact, as of I think the end of October, we are the best performers in Asia. So I think the drivers to help sustain that move are still in place, and I think there's still a lot of things that are not factored into the share prices, even if we're up quite significantly this year.
I guess it's interesting when you talk about a lot of things not being factored into the share prices, because valuation-wise, we are also relatively expensive compared to our neighbors, right?
Correct. Valuation-wise, we're higher. But again, the question is, if you look at the market and the companies that are in the market, there's a lot of them that have changed already in terms of what comprises their earnings, what makes up the revenue. If you look at gaming, for example, gaming was not there before, and it's still a sector that is still expected to just start next year. So yes, you're correct in saying that valuations would be quite lofty at this point versus Asia and versus, let's say, our 5-year average. But if you look at earnings, which would be driving share prices, earnings expectations haven't really been downgraded. The market is still expecting around 8 to 12% earnings growth. And if you look at our regional peers, actually, some of them have already experienced some downgrades in terms of earnings expectations. So yes, we're a little bit expensive on the PE side, but then we believe that the earnings is still supporting share prices at this point, which is why you are not seeing any significant moves if ever the market corrects. Because there's still some support to the market.
In other words, we may look expensive, but given the earnings that are going to come in the coming years, it's not that expensive after all, or it won't turn out to be that expensive.
It won't turn out to be that expensive. I mean, we're up 27% actually in peso terms, but if you just compare us to Asia, we're up almost 35% in US dollar terms, which is almost double what MSCI Asia ex Japan has returned over this year. Again, the fact that the fundamentals of the companies remain strong and it's underpinned by a very strong local economy, that's helping sustain current levels. And even if we're expecting that earnings growth would be like 10 to 12% for next year, we still think there would be some surprises along the way that might help the companies and also the market re-rate further higher.
Now, the government has been saying for a year, at least a year, maybe 2 years, that number one, we're overdue for an investment grade rating, and number two, that investment grade rating is coming very soon. We're on the cusp of that now. Does that still matter then? If everybody believes we're going to get an investment grade rating within the next 6, 12, 18 months, news such as we got this week that Moody's raised us to one level shy of that, does it still matter? Or why does it still matter?
Well, I think it still matters. Of course, I think in terms of the bond yields, we have already been, I think most of the investors actually price our bonds similar to investment grade Indonesia. So there might be some limited upside. I think if you look at the reaction of the market this week when the Moody's upgrade was released, we actually did not move that much. But it does help improve confidence in the Philippine market, and it helps improve our image to foreign investors, which also comprise a bulk of the trading activity in the local market.
Right. Let's talk about your favorite sectors right now. When you look forward to the Philippines in the next 2 or 3 years, what are the 2 sectors that you would say are the most promising?
Well, I think the thing that we like most is anything that would be linked to the domestic economy. I think we have shown to be, I mean, the Philippines has become quite resilient over the last couple of years, and the last couple of quarters have actually attested to that. So if you look at domestic consumption plays still are part of our top picks. And as I mentioned, there's a new sector in the market, which is gaming, which is yet to begin. I mean, yet to increase in terms of the size. Now you still have, I mean, you have one big integrated gaming facility, but that would be complemented by 4 more in the next 2 to 3 years.
So when you talk about domestic consumption, you talk about consumer stocks.
Consumer stocks.
And we have a list of that. This is not your list. It's just a general list of typical consumer stocks. What makes that an important sector?
Well, it's an important sector because, as we have been saying, the domestic economy has been very strong. That's supported, of course, by two significant streams, right? OFW remittances have remained strong and is actually on track to meet government expectations. The BPO sector has also been quite strong in that it's expected to grow another 20% this year. And other drivers of growth that are part of the local economy have yet to be felt, but we're starting to see some numbers trickle through. You would see, like, for example, electricity consumption is up about 8% for the first 9 months of the year, but actually industrial electricity sales are up about 14%. So that also shows you that in addition to your typical consumer-driven spending generated by BPOs and OFW inflows, you also have this manufacturing and industrial production starting to, in a way, restart or actually provide another driver of growth for the economy, and that's expected to actually sustain, spending in the local market.
And before we end, we're going to talk about gaming stocks. Some people say none of these gaming companies, except maybe for one, really has operations right now, so you have no idea what's going to happen to them. Why is it so promising, or is that the reason why it's so promising?
It's promising in a way because it's something that's new to the market. I guess people are also still not too... they're still a bit skeptical on whether it will actually execute or whether they will deliver. But as you said, there's already one company that will be starting operations by March of next year. The reason why we're excited about this is because we think that even expectations on the actual contribution of the gaming sector to the economy are still understated. I mean, now we're about 1.9 billion US dollars a year. I mean, this is based from PAGCOR, but of course, there are expectations that in 2 years this would be 3.5 to 3.6 billion. But then the market, I mean, even the foreign analysts are expecting that this is still a low number, that it's still, something that can be revised upwards.
I guess what's interesting about this is that if you look back 10 years, the BPO sector was non-existent or hardly existent, and now it's such a big thing. Is the gaming sector going to be something like that?
Correct. I mean, you mentioned the BPO sector. We always talk about OFW remittances before being one of the main drivers of the economy. It's 10% of GDP. Now the BPO sector is close to 5% of GDP. And we've been talking about gaming and the potential of gaming. I mean, if it's just 3.6 billion US dollars, then that's more than 1 percentage point to our GDP, right? So there's that huge potential, aside from the fact that, of course, it generates jobs. One licensee would be needing about 4,000 employees, and you have 4 locators in Entertainment City, so that's creating at least 16,000 jobs. So that's also expected to, to help underpin that consumer spending theme that we would be quite positive on.
Okay, Mark Canizares, thank you very much for joining us today.
Thank you.
Thanks.